me mute.
All right. Hello and welcome to another Lunch and Learn, a celebration of Black businesses. These Lunch and Learns are a collaboration between the City of Cincinnati, the SBA, ECDI, and the Minority Business Assistance Center. My name is Eric Denson. I'm a member of the City Small Business Team. Today we will talk about building financial reserves and many other related things to small business development and small business growth. We are very fortunate to be joined by Mr. Michael Porter of MD Porter PLLC in Houston, Texas. Mr. Porter is a CPA and financial advisor. He has many years of experience advising small businesses on financial matters. Mr. Porter, welcome and thank you for joining us.
Thank you for having me.
We are also
here in Houston, thank you.
We're also joined by Mr. Jerome Jones of the SBA. A couple of weeks ago, we had a lunch and learn about the CARES Act and PPP and idle loans and things of that nature. And we continue to get calls about that. And so Jerome Jones has graciously given us his time to be back. In case people have more questions, he'll be on standby to answer those as they come in.
Absolutely. Thanks for having me.
But first, we'll go ahead and get started. Please feel free to drop any questions that you have about the discussion in the chat, and we'll do our best to try to get to them during the session. So yeah, we'll get right to it. Mr. Porter, the pandemic has brought to light the importance of having financial reserves. Could you just, maybe start off by talking about some of your thoughts related to financial reserves and how much a business may want to keep on hand and how much, how they can go about trying to build their reserves, and maybe touch on some things like that.
Okay, well, thank you for having me this morning. I wanted to first start off with respect to a company. An individual should determine how they want that company to be structured. There's several ways to do it. You could do it as a sole proprietor. You can form an LLC, an S Corp, and in some cases, people do C Corps. But let me explain a little bit of why you would do a limited liability company, and it goes in line with building of financial reserves. Most people will do, say, a limited liability company or an S Corp because what they want is they want to have some level of protection. But remember, if you have a limited liability company and your company has made substantial profits and those funds are still in that company, if anything happens from a legal standpoint and that company is subject to litigation, you have effectively protected your personal assets, but the assets inside of that company are subject to the litigation. Which brings me to the subject of building strong financial reserves. What do you need inside of your company in order to make sure that you don't have too much in there, but you have the adequate funds there? You need to do financial projections. The financial projections that you do inside of your company should include expenses that you anticipate having, rent, utilities, purchase of supplies. If you have staff, you should have monies available inside of the company to pay your staff. Remember, if your company is selling something, you sell something and you then give your client or your customer a bill, and then you give your customer some time to pay that bill, what happens is the need for cash is immediate. So you can't go into a company without any type of working capital and expect it to survive. You've got to have some monies on hand so that you can anticipate the time that it would take for whatever you're doing to convert that into a cash from that sale or from that activity that you're doing. Some companies are just service oriented, and some companies deal with selling a product. So it's very important that you do your financial projections. And again, you don't want to put you don't want to leave massive amounts of funds inside of that company, because that company, that is a legal entity, and that legal entity is the one that is engaging in some type of business with a customer or a client. One of the things that I wanted people to know, it's a little bit off-centered, is a lot of people ask me, what is the best type of legal entity to create? And I'm going to just go ahead and tell you, go ahead and create, if you want to, a limited liability company, get your company organized as a limited liability company, and then have it taxed as an S Corp. So when you do that, you have the best of both worlds. You have a limited liability company has a very limited amount of structure to it in terms of having to have a board of directors, having to have meetings, having to have those meetings memorialized by minutes, as opposed to an S Corp. An S Corp is a formalized entity. And what I mean by that is, if you have an S Corp and you don't have a board of directors and you don't have minutes that memorialize meetings that you've had, you literally have violated the rationale for having created the company. In other words, I could, if I sued a company that was an S Corp and they didn't have their records together, I could pierce their corporate veil and I could get at their personal assets. So in order to avoid that, create a limited liability company, file a form 2553 where you're asking the Internal Revenue Service to treat that limited liability company and tax it as an S Corp, and you have the best of both worlds. One of the values of having an S Corp, having your company taxed as an S Corp, you can pay yourself a salary, and any remaining income inside of that S Corp is not subject to self-employment tax. Now you need to, when these are things that I'm saying, I don't want to get too much into that because the subject today is building financial reserves. Now, as they told you before, not only am I a CPA, I'm also a certified financial planner. And being a certified financial planner, we like to explain to clients the value of protection and the value of setting aside money. And let me give you a little example of what I'm talking about. Let's say, for the sake of argument, you're in a business and you have a partner. You and the partner go into business, you own the business 50-50. What people don't think about at the time that they form companies like that is, what would happen if something happened to one of the partners? And because they didn't think about it, something happens to one of the partners. And so the other partner now, the surviving partner, has to deal with the remnants of that event. The family of the partner that something happened to comes in and now wants to make sure that their interest is being protected, because the partner that is no longer with us gave them his interest in the partnership. Now, what you've got then is somebody that was originally in a partnership with somebody who knew what they were doing, who could actually benefit the business and was going to make that business a success. Now we have the family of that individual who probably doesn't know anything about the business coming in and trying to maintain their 50% control. What could they have done? And this is also part of this building financial reserve thing. What they could have done, or they should have done, was engaged in what we call a buy-sell agreement between the two parties. And this is where, because I have a financial interest in my partner and my partner has a financial interest in me, I could go to an insurance company and I could buy a policy on my partner. I could be the owner of that policy and the beneficiary of that policy, and he likewise could have the same thing with me. If something happened to me, we already have an agreement in place that says that my partner has to buy my interest out from my family. And that whole transaction is tax-free. because the proceeds that my partner would receive from the policy that he had on me is tax-free. Because I gave my interest in the partnership to my family's interest in that partnership would have what they call a step up in basis. The step up in basis would be equal to the amount that the other partner would pay for that interest. And so therefore there would be no gain on the sale of my partnership to my partner in that transaction. But let's just say nothing happens to either one of us. Nothing happens to either one of us. And what we did is we bought a whole life insurance policy on each other. And what's happening with that whole life insurance policy over time, and we're paying the premiums, is that it's building up cash value in the policies. That cash value essentially now becomes available to us for any type of liquidity needs that we have in the business that we have over time. And that's what we try to tell. As a financial advisor, I try to tell people, this is a good way for you to become your own banker. And here's the beautiful thing about that. When you're your own banker, if you don't want to make a payment, a loan payment, nothing happens, because all you're doing is paying yourself back. And the reason that you would pay yourself back in a situation like that is because what you want to do is always have liquidity available. And, one of the things that we tell people, Michael Dell of Dell Computers, he pays $1.2 million in premium on his policy that he has with life insurance. Do you think that he has to get up in the morning and go and put on a suit to talk to a banker to get money? No, all he does is he calls his insurance company and says, hey, send me X amount of dollars. Because I'm pretty sure he has millions of dollars in cash value in his policy. All right, so determine what type of legal entity that you want. Make sure you don't make the mistake of getting an S Corp. If you might want an S Corp, if you think that you want to have the formality of having a board of directors and having them meet on a periodic basis throughout the year and having the results of those meetings memorialized by minutes, and having your books and everything the same as a C Corp, you can go ahead and do that. But for the most part, small businesses that I've dealt with, they operate totally using the structure of an LLC, but they're still getting the benefit of an S Corp. If you have an LLC, the reason why I say you can pay yourself as an S Corp, if you have an LLC, you don't pay yourself. You don't pay yourself a salary. So what happens to a lot of people is they make money and they forget to make the estimated tax payments to the Internal Revenue Service. And then they come in, and then all of a sudden I look at the LLC and it's made a lot of money and everything is fine, except for the fact that now we have to pay payroll, we have to pay self-employment tax. It's not the federal tax that kills them most of the time. It's the self-employment tax that they have to pay. And that self-employment tax is 15.3% of whatever net income that you've made. And people say, wow, I thought I only paid 7.65 when I was working for somebody. Well, you are working for somebody. You're working for yourself. So you're both the employee and the employer. And so therefore you pay both sides of that particular tax. Now, ways in which what a person should do. Had this same conversation with someone earlier in the week. Here's what a company should do. Every time you make, say, $1, put 20 cents aside so that you can have the money to pay the taxes. And you have to make estimated tax payments 4 times a year. You make an estimated tax payment for the tax year on April 15th, June 15th, September 15th, and January 15th of the following year for the previous year. That January 15th payment normally is the one where you're correcting for the entire year. And so because your income is going to be varied throughout the year, you can make up for whatever you didn't pay in taxes for the first 3 quarters doing that January 15th payment. Make sure that you have your accounting records straight so that you can look every single month on what your company is doing. As an accountant, obviously I'm biased to this. I think people should have financial records. You should sit down on a monthly basis. If it's by yourself, you should analyze this by yourself. If you have partners, you guys should sit down and have a conversation every month and determine what your business did on a monthly basis. There's no sense in continuing a business if it's continuously losing money. That you're not in business to lose money. That's another thing. Some people, some tax accountants, some tax preparers, I won't even call them accountants, some tax preparers will try to create these fictitious companies that are designed to lose money. Well, let me tell you, you have to ultimately make money in whatever you do, because if you keep showing losses, the Internal Revenue Service is going to assume that what you're doing is a hobby. They're going to disallow all of the deductions that you had from previous years, and you're going to have a tremendous tax liability.
Mr. Porter, I mind if I come in and get a few questions that we have in the chat here? One of them, you were talking about the tax impact, and one question we have is it better to establish a corporation in which you pay taxes after expenses have been paid?
Is it better to create a corporation in which you take taxes after expenses have been paid? Yeah, I mean, look, the reason why, okay, you have monthly financial statements. Say you have your financial statements for January, February, and March. You know you're going to pay tax on the net profit. The net profit is the difference between gross income and all of the expenses. So regardless of whether you have, I know they're not asking me whether or not should you do a C Corp? Are they asking that, or are they asking should you, any entity that you do other than a C Corp is what you call a pass-through. A pass-through, an LLC is a pass-through, so likewise is an S Corp. What does that mean? It means that whatever activity that entity had passes through to the owners of that entity.
Gotcha.
So an LLC has members. Mm-hmm. 2 members in an LLC, whatever that entity did will pass to those members. If it made money, that money will be added to that member's taxable income. If it lost money, those losses will go to offset any other income that those members had on their personal tax return. Likewise, an S Corp does exactly the same thing. The only difference between an S Corp and an LLC is that you and I can go into business together and we can own it 50-50, but we may agree in an LLC that you're going to get 70% of the net income and losses, and I'm going to get 30%. So we can change the percentage of allocation in a limited liability company. If you and I go into an S Corp and there's 1,000 shares of stock in an S Corp and you own half and I own half, no matter what happens, we're going to split the income or loss 50-50 based on our percentage of ownership. That's the difference between the two entities.
Okay.
That's
we
what
have another.
when I say create an LLC, but have it taxed as an S Corp. You get the benefit of both worlds in that situation.
Okay, and we have a question here. A gentleman has a social enterprise. And so he's asking, is there any advantage of a B Corp over an S Corp?
Oh, what type of C Corp? Did you say C Corp?
He mentions a B Corp. Is there an advantage of having a B Corp over?
I'm not familiar at all with a B Corp. I have no idea what a B Corp means. The only other entity that I know of is a C Corp. And a C Corp is a taxable entity. That entity pays taxes. It is not a pass-through. This is the situation where when monies are coming from a C Corp to the individual stockholders, where you have the concept of double taxation. If you have a C Corp, and it passes money to you as a stockholder, you're gonna pay taxes on the dividends that the C Corp pays out to you. But I'm not familiar with a B Corp. That's a new one on me.
Okay. So I believe you had started talking about the importance of keeping accounting records before
Right.
we
The importance of keeping accounting records. Like I said, you don't want to have more. You want all your assets, your liquid assets, sitting inside of your entity, your legal entity, which means that you need to understand what your company is doing on a monthly basis, so that you can, when you do your financial projections, those projections are as accurate as possible. Let me give you an example. Let's say that I had a company where I'm selling widgets, but I don't know what my sales are going to be in the next couple of months. But what I do know is that I don't want to have a lot of cash sitting in that company at any point in time, because the sale of the widgets that I sell could conceivably cause my customers to sue me for one reason or the other. Let's just say that are my drivers that drive out to deliver my product to my customers could get in an accident or something like that, and they've got the name of my company all on the side of the vehicle that they're going out there with. So what I want to do is I want to make sure that I have enough cash inside of my company in order to purchase the raw materials that creates the widgets. If I don't have good, sound financial statements, there's no way I would know all of this. There's no way that I would understand it. But just in case I have an LLC or an S Corp and I didn't have enough cash, I could always make more cash contributions back into the company. All that would be is owner's contribution or owner's investment. So keeping the minimum amounts inside of the entity can be controlled by the owners. But again, the object of the rationale for getting a legal entity is to limit your legal liability, create a separation of your personal and your business, and allow you to do certain things. Now, building financial reserves. Like I said, one of the ways that you can build financial reserves, if you have a partnership, you all could engage in a buy-sell agreement between the two parties, or three parties, or four parties. It doesn't matter. If you had a company where you had 10 partners, you wouldn't want each of these partners to buy policies in each other. What you would do is call an entity purchase, where the company would buy policies in all 10 of these people. If something happened to one of them, the company would pay that person's family off, and then either redistribute that person's equity to the remaining 9, or they would just simply hold it in treasury, and the 9 remaining partners would then own 100% of the company. But the object of that exercise is to make sure that there was a plan in place that would take care of those type of things. And with COVID and cold weather and all of the type of things that we're having in the world today, having a plan that can anticipate what would we do if the worst thing happened in place would be a smart move. The best way to build financial reserves as the company is to have a company that has the ability to make some money. Okay, I mean, that's the first thing. The second thing is to build, to have strong financial records so that you can make management decisions on a timely basis. When I first took my first class in accounting, that was what was stated. Accountants prepared information to management to make timely decisions. The information that we prepare for our clients has to be accurate. Okay, that's what we are. We are people who can look at a business and help a business to make financial decisions. So the idea of setting aside, say, 20%, 15 or 20% so that you can pay your taxes makes sense. The idea of not leaving too much liquidity inside of an entity makes sense. But the real reason that you're in business is to make money. So come up with an idea or a service or a product or whatever the heck you're doing with respect to the business that you're setting up that makes money. But at the same time, maybe what you thought about was great in your head and it made sense on paper, but it didn't. Wouldn't it make sense to be in a business and within several months say, well, maybe this dog ain't gonna hunt, rather than to be in the business for a whole year and lose more money? I mean, that is the whole idea of having information that's accurate on a timely basis so that you can make decisions.
And it's interesting that you said one of the best ways to create that financial reserve is to be making money. And I guess the next step of that is the business owner sort of has to be serious about, putting some money aside. They may want to even treat, creating that financial reserve as a fixed asset, something that, once they get money, they dedicate it to making those reserves or putting money into a reserve.
Yeah, I mean, you have so many different things that, as you make money, let me get into the financial planning side. As you make money as an owner of a business, what do you do in order to protect that money and have it grow for you? Well, it's various things. You could open up a brokerage account. You could purchase annuities. You could go, there's various things. You could purchase assets that would improve your ability to make more money. You could invest in technology. There's so many different things that you can do if that company is making money. When I read the subject, building financial reserves, what I'm thinking about is you're doing things also to mitigate or limit the amount of things that can attack your income. For instance, these are some of the things that have happened as I've seen businesses. Give you an example of what happened to a dental practice that I work with. This had a young dentist who worked for a company that hired her, but used all of her dental certifications to start this business. And it was really weird. This is before I got with her. She allowed them to open up a business, and she in effect used her credentials for them to do that, but she gave them the responsibility of handling all of the bills, to pay the payroll and handle all the bills, and accepted for that a certain amount. Well, over time, the person that was behind this failed to pay the bills and failed to make certain payments to the Internal Revenue Service. And the bottom line was that business filed bankruptcy, which caused her to file bankruptcy. Well, then after she did that, she decided, well, if I'm going to be a dentist, I'm going to open up my own dental office. But here was the problem. She had a bankruptcy on her record, and she could not buy the equipment and all of the different things that she needed to do in order to open up the business. But she was such a good person. That was an individual that basically had some old dental chairs and stuff like that. And he allowed her to use that. And he also, her x-ray machine was an old x-ray machine, and she was doing pretty good. But here's what happened. She didn't want to do her payroll through a payroll service. She wanted it to be done manually. Now, the way that the IRS states it, if I have payroll in January and I take out all of the payroll taxes from the employees, I don't have to make that payment to the Internal Revenue Service until the following month. So every month, she was making payments to her employees and it was the net pay that was owed to the employees. But the payroll tax, which included the payroll tax that was deducted from their payroll plus her match, because she had to match Social Security and Medicare, didn't get paid until the following month. Well, she kept doing that. She kept doing that, but she started getting behind. She started getting behind. All of a sudden, she owed massive amounts to the Internal Revenue Service for back payroll tax. Now, that is the one thing that will kill a company, and it literally killed her company. And here's what happened at the end of the day. She wound up paying, she wound up having to go work for someone else, and she sold her practice. And her practice was sold for $750,000. But because she didn't pay those payroll taxes with penalties and interest, you know how much of that $750,000 she wound up with? $60,000. All the rest of the money went to the Internal Revenue Service for back payroll tax penalties and interest. And I saw that, happen to several companies. So there are certain things that you have got to make sure that if you're talking about building financial reserves, you've got to keep the money that you have in there. Can you imagine all that hard work that she had built that practice up? And it was a great practice. She was a great dentist, by the way. That's what happened to her at the end of the day. Not having the ability to understand cash flow, not having the ability to do much because of making the mistake originally. She couldn't borrow money because of the bankruptcy, so there was no way for her to get any funds outside of what she was getting in the practice. And the practice was it was a very lucrative thing. And the other thing, I had another client. I mean, this is really happening. I'm not, this is not coming from anywhere. It actually happened. Had a young doctor. This is what happens with everybody that I see. They try to do everything. And this doctor, instead of hiring a billing company, decided that she was going to work all day, and at night she was going to do her own charts, and she was going to bill Medicare and Medicaid and all of the insurance companies. Well, she got tired, and over a period of time, she got behind. And when she finally decided that she was going to bill Medicare, she was denied payment of over $250,000 because all that information was too late. So one of the ways to build up your reserves and stuff like that is make sure that you hire the right people at the right time. When you're deciding whether or not you're going to go into business, put a little something in there for anything that you don't feel comfortable in doing. If you don't feel comfortable in doing your books and records like that, at least get a bookkeeper. At least do that. Okay, and make sure that that bookkeeper knows what they're doing. Because you need to have that information as quickly as possible so that you can make decisions. If you have employees, it would be good to hire companies like ADP, Sure Payroll, or someone like that so that they can handle all of that stuff. Because I assure you, a lot of companies go out of business because of things like that.
You're making some real good points. And part of our role at the city is to get out and meet with businesses and, just sort of try to find out what type of situations they are in. And a lot of ones that we meet with, and this falls in line with a question that we have, they're working with QuickBooks to do their accounting. And that's mainly for the record keeping piece. And they say that, a lot of them can't afford accountants. But as you know, and I think we may have even talked about this the other day, there are some important business decisions an owner may need to make that they might not be able to understand just by looking at QuickBooks. And that's sort of where that accountant comes in. Can you speak to that a little bit?
Yeah, I have a lot of clients that, will have QuickBooks QuickBooks is a great accounting software. A lot of times, what people do is they use all of the technology that they can. I had one client, QuickBooks allows you to download information directly from your bank into your QuickBooks. But if you don't watch what's happening, if you have an error, sometimes some of that information doesn't come across. That error will magnify itself over and over and over. And by the time you finish the end of the year, you've got a mess on your hands. If you, there's some like my practice. Sometimes when someone comes in and I know they're very new company or something like that, and they don't really need to have me work on their books on a monthly basis. They have someone that can do, say, QuickBooks. What I do is I may do a contract with them where I come in 4 times a year, every quarter. Take a look at what that individual has done for the previous 3 months, correct any errors that I saw, make sure that the person that's doing the books understands what I did so that they cannot make those errors again. And the cost is very reasonable. The cost is very reasonable because all they're doing is paying me to come in and kind of supervise a little bit on a quarterly basis. I do that. I do that personally, not only because maybe I'm doing the tax return for the individual, but I'm also having the ability to assist that individual with their financial planning. So my practice is different than somebody else's practice because I don't need to try to make all that I need to make from the accounting services or tax services that I give to a client. Because my main goal is to help that client build wealth. And as that client builds wealth, if I'm also providing financial planning services for that individual, then I benefit from that as well. We both benefit. But that cost, that little bit of cost, even though I'm saying that I charge a small amount, should be part of your consideration when you're doing business. You have to have that information. And if you can't do it totally by yourself, find an accounting practice or someone that can give you a number that makes sense so that you can get that information. You need that information. Because that, to me, that's as far as I'm concerned, when you're talking about building, financial reserves, having that information and having someone that you can have a conversation about that type of thing is the key to everything. To everything. When that individual is going to build something and then he asks you, well, I need to go to the bank because I need to borrow money. If you have your financial records in order, and you guys at SBA know this, if the person can come in with some stuff that you all can look at and reasonably feel confident that that information is correct, it goes a long way in making a decision whether or not you want, to guarantee that loan, or even a bank who doesn't need SBA wants to make a loan to that individual. So in the long run, it might cost a little bit and cause you maybe to have a little less in the beginning, but it's worth it in the end.
Yeah, I think you addressed that real well. The fact that they may not need you all throughout the year. You could just come in periodically,
right,
and make sure that they're handling things the way that they need to be handled so that they don't run into anything that may get them shut down. I think that's a
exactly
response.
Exactly.
Response.
And I have several clients. I have clients that do have that really strong accounting, but they still do that. Companies that make $4 or $5 million a year, and they still will have me come in to look at it. And then around tax season, I come in, and then it's not so bad when I do their tax return because I've been there. It makes it a lot easier.
Okay, I got a question here. I take it they are referring to when they're seeking financial support to gain capital or build wealth. I'm guessing they're referring to maybe when they're looking to find someone to help them, give them advice on gaining capital or building wealth. They're saying, what type of questions should they ask that entity that they're seeking that advice from?
Well, find out if they have services that does not require that someone completely takes over their accounting services. If they, either the owner or the owner's, staff that they have, or if it's a husband and wife, maybe, the wife is the one that's doing something and the husband can be the bookkeeper per se. But if that person isn't comfortable being a bookkeeper or whatever, ask that firm if there's a way that you can you can have a contract that allows him to kind of review things on a quarterly basis. Your startup company, you don't have much capital, you can't pay for full-time external bookkeeping. But what you need is the expertise of that individual, and see if that's available. And if you can't find anybody with technology, call me. That's it.
Okay. Well, let's go a little bit further. If you're okay, let's go a little bit further into some of what we talked about the other day as far as budgeting, the importance of budgeting and planning. You mentioned that you advise businesses to maybe go out 2.5, maybe 3 years with their budgeting and planning.
Right. That's something that I personally do, and that clients that I have, I do for them as well. I literally can look right now at my bank account, and then I'll put whatever balance I have in there. I'll reduce. I have a list of everything that I have coming in and all of my expenses. And so I look at my bank. If I look at my bank account, I see which bills have been paid. With online banking, you should do everything online that you can. Literally, let the bank do a lot of the work for you. But I do projections personally and for my business for 3 years, and I know what I have now, what I expect to have at the end of this month, what I'm going to have at the beginning of March. And it goes all the way out for years. And what I'm looking for is if I see any negative numbers. I don't care what the number is, as long as there's a positive number, I'm good. If I see a negative number, say I see a negative number in the first quarter of 2022, well, I have enough time in order to make an adjustment, because there's only two things that I can do. I either can make more money or spend less money. But rather than that happening to me and coming up on me where I am in a panic situation where I'm trying to make a decision because it's on me right there, I can make a moves here in 2021 to eradicate that problem in 2022 if I see the problem is there. My financials or my projections have to be accurate. So what you have, when you have expenses, you have fixed costs and variable costs. Fixed costs are things like might be your note payment on your home, on your car, the insurance that you pay for the car or the home, and you're paying on a monthly basis. Those numbers are going to be the same every month. And you're going to have variable costs like food, entertainment, cable services, if you're prone to every once in a while getting a movie or whatever. But you break out your costs between fixed costs and variable costs. And variable costs, they could be determined by prior costs. And so you're looking at it, and then you put in there a little bit for miscellaneous, because you always have miscellaneous. If you do that, you discipline yourself. You make yourself accountable to you. You are your own business, whether you work a W-2 job or not. You are your own business. What you do with what you make is determining whether or not you will have those financial reserves. And I've been reading this book about this guy that wrote this book about what would the Rockefellers do. And I don't want to get into that. It's different than what I want to say. But there was something he said in the book, is that unless you do that, unless you get a hold of your personal situation, you will never, ever, ever build financial wealth. You won't do it, because if you are an individual that says, well, I'm going to spend what I have, and well, here's what happens. Because I was talking to a person the other day. What happens is, we got credit cards now. And so if you don't know that you're living within your means, then you start using those credit cards, and all of a sudden that balance starts going up and higher and higher and higher. And you're paying 24% interest in a period in which the interest rates on homes like now in some cases under 3%. You're paying 24% because what you decided is you wanted to spend more money than you were making. Well, if that's who you are and that's how you ride, there's not much anybody can do for you. But if you recognize that, if you can discipline yourself by putting a budget together, a strong budget that you're willing to live with, you can build wealth. I can show you numbers. If you take a person that's 35 years old, and you look at that person and say, okay, that person can save $500 a month, and they're earning, say, 7% on that money. You will make yourself a millionaire if you can sustain that prior to becoming eligible for retirement. You will. I mean, you just will. The math works. The math works. What doesn't work is discipline. You cannot, there's so many things that you guys have an opportunity to do that people in my position have to just accept where they are. I mean, if the younger you are, the more you can become a millionaire. You literally can with a W-2 job if you want to. The object of that whole exercise is to get control of what you're spending relative to what you're making. That's simple. That's a simple thing to do. Just because your friend just bought a Mercedes don't mean that you got to go buy a BMW. Hyundai works just as fine. Okay, those are just simple acts of making sure that you live within your means. Especially, wouldn't it be, okay, if I'm driving a Hyundai to my job to my company that I just created, who cares? Because I'm trying to put everything that I can into that business. I'll get the Mercedes later. It gets you to the same spot as that Hyundai. So you have to get a control of what you're spending, and do the budget. Do the budget and then check it out. Check it out. Look at your bank statement for the next 3 months. You can do it now. By the end of you can do it now for the rest of February and get into March. And by April 1st, you could be on track to actually creating the type of financial wealth that you want. And it's up to you. It's up to you.
Yeah, and I was going to say, in the case of a business, doing that budget helps answer that struggle that they may have of, when I'm making money, do I put money aside to my financial reserves for a rainy day, or do I put it back into the business to try to grow it?
Right. And the way that I would do it, Eric, is this. The type of business most likely that a small business is going to have is going to be a pass-through. It is going to be an LLC or an S corp. Just because you took the money out of the entity doesn't mean that you have to spend it, or you have to put it someplace where you can't get it. Go to bankrate.com, find the highest money market rate that you can get. Right now, we're talking about 0.5% or 0.75%. It's not going to be high, but put that money there. Put that money there. So it's outside of the company, but it's available for whatever that company can do. Also, at the same time, if you were smart and you went ahead and got those whole life policies that I was talking about, that builds up liquidity opportunity as well as protect your family. Then you can go out there and buy a term policy, which is nothing, nobody gets anything unless you die. You don't want to do that. You want to get something that is of value to you. And for those of you all that want to understand more about financial planning, I can show you something that with those type of policies, that regardless of what you have, at the end of the day, by having that type of asset, you could actually improve the way that you live, the amount of money that you can pull out of the accounts. Let me give you an example. Let me give you an example quickly. And I know that I'm going back and forth between financial planning and accounting and whatever, but this should be something that educational type luncheon meeting. Let's say, for the sake of argument, you save a lot of money in your retirement account, your thrift account, whatever retirement accounts that you have, and you've accumulated $5 million. You've accumulated $5 million, and now it's time for you to start. Let's forget about Social Security or any other type thing. You're going to live off of this $5 million. That $5 million is still invested in the market. However, it is comprised of qualified money, meaning that every dollar that you take out is going to be taxed to you at ordinary income tax rates. So you got $5 million. The question is what percent of that $5 million do you feel comfortable taking out every single year? And once you determine whatever that number is, you're going to take out that same amount every year, but you want to be comfortable that you're never going to run out of money. And if any of you all are on this call that understand, any financial advisor is going to tell you somewhere between 3 and 4%, and it's going to be based on a Monte Carlo simulation model. And what that model does is it runs thousands of calculations to determine, based on how the market goes up and down and whatnot, it's going to say between 3 and 4%. So let's use 4%. So let's assume that you're going to pull out of that account a taxable amount to live off of $200,000 every single year. And you're not going to be 100% confident that you're not going to run out of money. You're only going to be 80% confident that you're not going to run out of money. So no matter what the market does, you're going to pull out $200,000 every single year. And that $5 million, if you had another 2008 where the market went down 40%, that $5 million is going to go down to $3 million. Okay, but you're going to still be pulling out 200,000 because that's what you're living on. We're not assuming that you're going to. Okay, what if I told you, because you listened to me, and now you have another source to pull money out of in bad times, but because you listened to me, you only had $3 million. But because you listened to me, you're able to pull out 8% of that $3 million. And not only that, that amount is guaranteed. Which case would you do? What would you, which do you want 200 or do you want 240? 240 that's guaranteed or 200 that's 80% guaranteed? Do you see what I'm saying? This is how, when I talk to my clients, yes, I'm talking to them about their business, but I'm also talking to them about their other business, which is them, which is how they're going to be when they get ready to shut their engines down and begin to benefit from the fruits of their efforts. Because of that, I tell you, that's the kind of thing that if you get the right kind of advice, you can handle. Somebody tells you you have less. It's not about how much money you have. It's about how much money you can spend. You guys get it. Now I can prove this to you, but do you understand what I'm saying? You get it? You have to have someone who can take you through this lifelong journey of where you are now and where you want to be. And they have to prove it to you. Most financial advisors are only worried about you getting that $5 million. Once you get up to the top of Mount Everest, you plant your flag, you're happy. I made it. But guess what? You got to get down. You know, more people die going down than going up, and they leave the bodies there because it's too difficult to bring them back. If you only worry about your accumulation phase in life, about how much money you're going to accumulate, and not worry about the distribution phase of your life, you're making a mistake. You got to get down that mountain.
Good point. I'm doing a sweep of the chat to see if just want to make sure I touched on the questions that are in here. Got one in here about sample budget templates and projection templates. I believe there are a few sites that would have some generic.
Even Excel has that in there if you like that. I mean, I personally like to build them from scratch on an Excel spreadsheet.
Okay.
Yeah. That's how I made my bones when I became chief financial officer for a financial institution. I was a lowly accountant. I wasn't lowly accountant. I was vice president special projects, but I used to work on financial projections for the company. And and I got good at doing that.
So I'm pretty sure we touched on this. One of the main advantages of the LLC is to protect your private assets, correct?
Correct. You've got it's in the name, limited liability.
Okay. Jerome, are you still there, Mr. Jerome?
I am indeed.
Got a question here asking if there are any PPP updates.
From my last call, no PPP updates. The PPP is back, as most people know. You can get a second draw, and what that means is if you've received your first draw or already received a PPP loan, up until recently, you could not get another one. Well, when this next stimulus came out in January, you now are allowed to get a second PPP loan. However, there are certain stipulations surrounding that, the main one being the 25% reduction in gross receipts. And what that means is you have to show that you're making 25% less in gross receipts. That's your top line revenue number, not your profit. And it's comparable to a calendar quarter in 2019 compared to that same calendar quarter in 2020. You can also do it on an annual basis. What we're running into a lot now is that businesses, particularly in the food service, accommodation, and restaurant industry, is that first calendar quarter, that January, February, March quarter, does not reflect a true representation of the amount of pain that they received. And what I mean by that is most restaurants were open in January and February. It wasn't until March that they were forced to close. So they cannot show a 25% decrease calendar quarter. However, if they were allowed to use March, April, May, which is a 3-month period from 2019 to that same 3-month period in 2020, that loss might be 70%. But as of right now, it has to be a calendar quarter. So we're awaiting guidance, but as of right now, it does have to be a calendar quarter. So that's probably the biggest change with PPP, is that you can get another one. It's limited to $2 million as opposed to $10 million. That's really not going to be a problem. The average PPP loan was less than $150,000. So I haven't had any outcry from anyone complaining about the $2 million. So it's back. It is a little more targeted and whittled down to try to get the money to businesses that need it the most and were affected in a greater capacity.
Okay. Question just came in, Mr. Jones. It says, can businesses with less than a year of operation, no taxes paid yet, can they apply for a PPP loan?
No, you have to be in business prior to February 15th of 2020. Now, there are some companies that were in existence prior to February 15th of 2020, but they weren't really doing anything. So there's no way that they can come up with the revenue, or excuse me, the payroll that they would need in order to multiply the 2.5 times. So, you know, being in operation, being in existence and being in operation are two totally different things.
Good point. Do you have any idea how long PPP approvals are taking right now once they are received by the SBA?
I don't have any solid numbers on it. It is taking longer now, I will say. In the first round of PPP funding, once the application was loaded to the SBA, we simply assigned it a loan number. And so it was almost instantaneous. This time around, they're doing a little more due diligence, and it is taking a longer period of time. I don't have an exact figure as to, you know, it's taking exactly 1 week, but you can imagine the sheer number of applications, millions that are coming in. It's taking definitely longer. So, you know, expect a delay of anywhere between a week to 2 weeks, but I have no concrete numbers on that.
Got a question here for Mr. Porter and/or Mr. Jones. It says, what are your thoughts on a second idle draw? Should a company take it if they qualify? Should they hold it and give it back if not needed?
I cannot render opinion, so I will defer to Mr. Porter.
Okay, well, let me put this back on. Let me ask you a question, Jerome. These EIDL loans are what, 3.75, 30 years?
Correct.
That's if you don't need it, I mean, pay it back. But that's pretty good. Those are pretty good terms, right?
It's about as best as the government has ever offered.
Exactly. So I would tend to say, well, it depends on your account. If you have a company that has some liquidity needs and stuff like that, go ahead and get the money. Get the money. 30 years. You're talking about, depending upon how much you're getting, I think like what, for maybe every, just as a ballpark, for every $25,000, you're paying what, about $100, something like that, somewhere like that.
Right, that's pretty good.
It's deferred for a year.
Deferred for a year, no prepayment penalty.
No prepayment penalty, get it. See what happens within the year, and if you don't need it, you could then pay it back because the payments aren't due for 1 year from the date in which the funds deposited into your account.
$25,000 would be about $115 a month.
Yeah. Yep. That's on 25,000. So you know, every 25, just double that number. So I would tend to get the money. I would tend to get the money. Yes. Yeah.
Okay. And I actually have another note here. Same question for the PPP.
Oh,
if you're eligible, should you go ahead and apply again to get it?
Jerome, you can answer that one easily.
Yeah. If you qualify for that money, and it is not a loan, I mean, I can't call it a grant because you do have to use the funds as required, but it ends up being free money. And I had a call from a lady last week that said, well, you know, I only qualify for $1,000 and I've got to fill out this paperwork. And I said, well, put it this, let me ask you this way. If someone was going to give you $1,000 and you had to fill out a little paperwork, would you say, oh, you know what, keep your $1,000. I don't have the time to fill out the paperwork. Or would you say, let me have the paperwork and I'll take the $1,000? You'd probably fill out the paperwork and take the $1,000. Unless you're doing much better than I am.
And if this is your second loan, the financial institution that you got the first loan from makes it so easy. I've got clients, it's so easy because they have a lot of the data already. So it's not even a burden to request that second loan. And all you got to do is make sure that a certain percentage of it is to pay certain things, which includes payroll. It's paid.
Yeah. The issue that I run into most often with PPP, and I know Michael can speak to this, if you're a sole proprietor, you get that money, you pop it into your personal bank account, and good luck trying to keep track of all of those expenditures, because you really have to keep track of the 60-40 split. And a lot of sole proprietors, they're not used to that. You know, the business money is their money, they intertwine it and they don't separate it unless they have to. And in order to get that loan forgiven, you really have to do that. What we suggest, we can't make anyone do anything, but what we suggest on the front end is open up an account and put all of the PPP money into that account. And then just write a check out of that account every month or every week for $500 or whatever. Right. That makes it so much easier. Right. But now I'm getting calls from people who say, okay, I didn't do that. Now what? Then I have to defer to
it's a loan.
For the Mr. Porter and say, you know,
Mr. Jones,
bring him your shoebox.
Yeah, that's excellent.
Bring me the shoebox.
That's an excellent point. That gets back to what Mr. Porter has been talking about all along about good record keeping. Definitely would come in handy in helping you try to get that loan forgiven.
Yep.
Okay, this is wrapping up. Is there someone who can walk me through the process for application? I believe the local SBA office is helping people.
Well, no, the SBDC can. We really don't we don't have the manpower right now to walk people through the application process. If it's a PPP loan, your lender has a portal. You know, every lender has their means of uploading the application, and usually they can have someone that can do it. Your local small business development center can assist in putting that together. Your tax or accounting professional can usually help you put it together. Now, this is the time of year that they are typically more busy than normal. So, you know, that's all based upon availability.
Great. Okay, I think that is what we have for today. I want to thank everyone that's on this meeting for joining us. I certainly want to thank Mr. Porter and Mr. Jones for lending their time and their expertise. Thank you guys, really appreciate that. And before I close it down, any last words you two may want to give?
I don't. I'm just hope everybody took what I said to heart. And if anybody wants to talk to me one-on-one, you know, call me. I mean, we're just Texas just freezing, so.
I'm just glad you were able to come through, because you're telling me you guys had snow, and y'all know you don't handle that well down there.
So we don't handle it well. No, we don't. I didn't have internet service for a while. I didn't have, you know, I got family members without, some of them have lights but no water. Some of them have water with no lights. I mean, it's everything.
And for me, the PPP loan is still available. We also have the EIDL loan, Economic Injury Disaster Loan. That is still available. The EIDL loan is through the website COVID, COVID 19 relief, RELIEF.sba.gov. That's 3.75% for 30 years, as we said earlier. You can get up to $150,000, so take advantage of that. PPP is still available through March 31st through the local lenders. So any SBA approved lender And that's going to be, you know, almost all lending institutions at this point. And your credit unions and your community banks. So don't overlook those. It's widely available. You can almost throw a rock at any direction and hit a PPP lender. If you're in the Ohio area, ECDI is also taking PPP applications, Economic and Community Development Institute, ECDI.org, ECDI.org is their website.
Perfect, perfect. Thanks again, gentlemen, for joining us. Thank everyone out there for joining us. I do want to thank the planning team, Nicole Picard of the SBA, Valeria Cummings-Swope of the Department of Economic Inclusion with the City of Cincinnati, Deborah Davis of the Minority Business Assistance Center, Ella Fry and Maury Griffin of ECDI. Thank you all for helping to put these lunch and learns on. I hope everyone will join us next week. Same day, same time. We will have Mr. Eric Kearney, President and CEO of the African American Chamber. He will join us to talk about the recent study that shows the impact that Black businesses have had on the local economy. Be some really good information, really enlightening information. And we'll also have Brian Jackson. He's the co-founder and CEO of Esoteric Brewing Company. They are the first minority-owned brewery within city limits. So with that said, again, thank you all for joining us, and I hope you enjoy the rest of your day.
Take care.
Thank you.
Thanks again, guys.
Bye-bye.